You're watching All About Money on HKIBC. I'm Isabel Wong. Well, as one of the world's most expensive prime office markets, Hong Kong is starting to buckle under the strain of China's economic slowdown and global trade tensions. Data from commercial real estate agent Colliers show that new leases in the city to mainland Chinese companies fell almost 40% year-on-year in the first half of 2019. Average office rents in Hong Kong are also likely to fall for the first time in 6 years. Here to tell us more is Rosanna Tang, Colliers Head of Research for Hong Kong and Southern China. Rosanna, welcome back to the show. Now that your team has put together such an amazing report about the outlook in terms of the second half of the property sector in Hong Kong. So my first question for you is that it's one of the most pressing questions in Hong Kong at the moment, which is about the political unrest. Obviously, due to weeks of protests, there would be businesses being affected. There would be many sectors in the city are being affected. So what about the property sector? How are investors, tenants and owners reacting to this situation?
I think in general, the market that we see at the moment, of course, due to the recent political tension or some of the global uncertainties, we are seeing more like for the investors and occupiers, they tend to wait and see in the market. And for them, some of them will be turning more cautious mode. And that said, I think from what we've observed in the market, some of them may take a longer negotiation time, or some of them may take a longer period before they make a business decision. And actually, I think last month we also published another report for the Hong Kong Office Occupier Survey, which we received the occupiers' response for more than 360 office occupiers in the market. And I think the outlook or the intention over the next 12 months is relatively more uncertain, with 9% saying that they would like to wait and see in the market. However, from a more long-term perspective, over the next 3 years, I think more of them are seeing that they would like to expand in the Hong Kong office market. So it also demonstrated that it's more in a way that, yes, in a short-term period, people are kind of wait and see, but in the longer run, they're still having a positive trust in the Hong Kong market as a whole.
Mm-hmm. Yeah. So in the short term, have you spotted any sort of, say, unusual movement in terms of asset allocations of investors in the property sector?
I think so far, from what we've heard or talked to the clients, they are still very confident in the long-term prospect in Hong Kong. We haven't seen the cases of people drawing out their capital or sell their property to drive their capital to other countries. And in fact, I think investors nowadays should be more sophisticated, not only talk about this round of the short-term turbulence, but I think overall we have seen a different cycle before in the Hong Kong property market, like in 1997, 2003 in the SARS period, and 2008 with the GFC financial crisis. People are aware of how this historical cycle will play out, and every time think Hong Kong will just rebound and bounce back for a stronger performance afterwards. So I think this time they will also think of something similar, and they would like to see and wait.
Mm-hmm. As you just mentioned, most of the investors, they are taking a wait-and-see approach. But then, does this kind of this period of uncertainty in Hong Kong, has it created any sort of, say, new opportunities for any markets around the city? Are some of the investors actually actively looking elsewhere?
I think, again, when we talk to our clients, most of them are still looking to park their money either in Hong Kong or in the GBA area. And this is also back to the way that we mentioned earlier. Hong Kong still have a very strong fundamental in the long run. And in fact, if you look elsewhere around the world, I mean, everywhere else has their own problems and challenges, like the US-China trade war is actually weighing on some of the economic performance in the US market and China market as a whole as well. And elsewhere in the Eurozone, we also have the Brexit that are ongoing. And if you look into the Pacific area, like Australia recently, we also see some downturn movement or slowing momentum in the market as a whole. So I think investors nowadays are still very interested to park their money with some of the initiatives ongoing, like One Belt One Road or GBA initiative that are for long-term investment opportunities in this area in Hong Kong and China.
As I just mentioned earlier in the program, that businesses are definitely in some way affected by the political situation in Hong Kong at the moment. But then, in your view, what would be some of the sectors that could be hit most by such political situation?
Well, I think inevitably every sector will feel a little bit of those heat. But if you ask which sector will be impacted most or feel the immediate impact, I think inevitably those retail or tourism related sector will perhaps directly feel the heat because of the some of the protests. Perhaps they will interfere some of the shops or retailers in terms of their opening hours or some of their strategy, how they could play out in the market. And I think this is also recently reflected in the government figures of the retail sales growth has been slightly corrected on a year-on-year basis for June and, well, actually for the first half of 2019 as a whole as well.
Yeah, and then the other risk other than this political unrest in the city is that obviously the US-China trade tensions, because obviously Hong Kong plays a pretty important role in terms of boosting the trade and the financial activities between the two countries, obviously. But then recently we've seen Hong Kong's retail sales figures, they are not really going so well. So is the trade spat between Beijing and Washington really taking a toll on the Hong Kong economy? Like, how is the property sector affected by such event?
I think, as we mentioned earlier, I think different sector will play out differently because they have different market fundamentals and demand-supply momentum. I think generally speaking, for office sector, we indeed seeing a relatively slowdown in terms of the leasing momentum because of some of the PRC firms or some of the flexible workspace operators. They are kind of being more like wait-and-see attitude before the lease in the market. And for the retail sector, as we discussed earlier as well, there are some of this shifting spending habit in terms of the Chinese tourists, as well as the recent political tension may have certain impact in some of the F&B operators. But for the high street or core location, we still see some of the overseas brands are still attracted to those prime area. And of course, for the trade, for the logistics sector, yes, in a way that perhaps for the first few months in 2019, the trade figures are not particularly exciting, but because the logistics sector has so limited space or limited available space for the tenants and very limited supply. So actually we are seeing that the occupiers themselves are still very active in negotiating or bring forward the negotiation renewal terms with their landlords because they just fear that they may have no space to go after lease expiry. Yeah.
Another potential headwind for the city's market and maybe specifically the property sector is that the US Fed recently announced that they are doing a rate cut. So historically, really, if the US economy catches a cold or sneezes, there would be some impact to the Hong Kong property sector. So what do you foresee the rate cut from the US Central Bank will do to the local property sector?
Well, I think in fact, this may be a positive spin to the Hong Kong market as a whole because, as we mentioned earlier, on the other hand, we have some of the uncertainties happening around trade war, about local tension, and some of the slowdown of economic growth. So perhaps this kind of new move from the Fed that they are cutting the rates at the moment perhaps should send a stabilizing signal to the market that the interest rate is going to be relatively more stable for the next couple of months or even a slightly downward adjustment that may actually have an impact or positive impact to the Hong Kong property market because the borrowing cost or financing cost will be lower for the investor.
So you just mentioned the office market and also a little bit about the logistics side of the property sector. But what about something that most people are concerned about in Hong Kong, which is the residential market? Like, what would be the outlook like in the near term?
Well, indeed, I think for residential sector is always very sentiment driven. Like what we've been seeing, like last year when the trade war broke out, the transaction volume has been slowing down. But it indeed, after several months, people started to digest the message, and it has rebounded very substantially in the first half in 2019, no matter for the price or transaction volume. And so for the second half, of course, with all these kind of uncertainties that we mentioned earlier, probably we will see more volatility in the market and because of these uncertainties still playing their cards. However, I think because the demand or the pent-up demand in the residential market is still very strong at the moment, given the supply shortage has actually been ongoing for more than a decade already. So with these kind of pent-up demand, recently we have been seeing is mainly focusing on the primary sector. So for the later half of this year, I think the residential sector, how it performed will also be very tied into how these developers are launching their new projects and in terms of their progress and how they set up their price range.
Now, very quickly, like you guys are actually forecasting a 1.3% drop in Grade A office rent in Hong Kong. So other than Chinese firms not renting out the offices, like what other factors are hurting the demand in the city at the moment?
I think generally speaking, the trade war impact is still there because of the uncertainties issue. Like we discussed earlier, people are still wait and see. And we indeed seeing some slowdown of the PRC firms' demand coming into Hong Kong, and i.e. most of them would be concentrated in the central area before. And at the same time, we also see a slightly slowdown of the expansion place from some of the flexible workspace occupiers. So that said, this kind of pressure may be more focusing in the core location, which we actually see that for Central and Admiralty, they have been experiencing 4 quarters of negative take-up in the market. And that's why we are forecasting perhaps a correction or some of the rental pressure that are coming through in the core location, and that may weigh down the overall office market rent as a whole.
All right, Rosanna, I hope that thought you're sticking around. But still to come on the program, China's economic growth fell to its lowest in almost 3 decades in the second quarter. How is the sluggish economy going to weigh on its property sector? Stay with us. Welcome back to All About Money. Well, Chinese state media Xinhua has reported that China will not use property sector as a short-term measure to boost economic growth. It has also been reported that Beijing plans to boost consumption with more reform measures amid increasing downward pressure. Still with us is Rosanna Tang, Colliers Head of Research for Hong Kong and Southern China. Rosanna, in the first block, we focused more about the Hong Kong property sector, but now that we would like to get some outlook and some insights from you in terms of specifically about the property sector in the southern China, because recently Xinhua, the Chinese state media, reported that Beijing, the government, is not planning to use the property sector as a short-term tool to boost domestic consumption and economic growth. So, in your view, what kind of message is Beijing sending there, and what does that mean to the property sector in China?
I think it is not the first time for the Chinese government to state the ground that property is something for the, well, at least for the residential sector, property is something for the people to live, but not for something as an investor's tool for speculation. I think this time the government is just trying to make this message even clearer, to make a more stabilizing trend for the China residential market going forward. So what does it really mean, or what will be the potential implication to the investment market in China? I think currently we have already seen some of the figures saying that the transaction perhaps have been slightly slowed down in the first half. But I think going forward, what people would expect is that the government will not back down on those kind of cooling measures that they have imposed in the market earlier, which because of the repeated stance again, I'm sure the price or the transaction volume will be relatively more stabilizing going forward for the next couple of months.
So one of the biggest headwinds that have been hitting the Chinese market obviously is the US-China trade war. So in your view, is the trade spat between Beijing and Washington a curse or a blessing to the property sector? Because obviously from the recent economic data from China, we're seeing that industrial output production and the investment sentiment has been hurt quite a bit. But then from the figures that we're seeing, that fixed asset investment, they are not really they're not really going down. So what does that really tell us?
I think in terms of the fixed asset investment, the FAI usually means those, other than the property itself, it also means the infrastructure, machinery, some of the physical assets. So I think currently with the Chinese government playing more national initiative like One Belt One Road, like GBA initiative, they're actually implementing or rolling out quite a lot of these kind of infrastructure or transportation projects. And I think the government also explained these kind of figures for the first half. These kind of growth is also more coming from the high-tech projects as well as the transportation projects. So I would see that even though trade war is still in the background, but these kind of big initiatives is still leading the growth of the FAI in general. Yeah.
And one of the biggest themes about the US-China trade war is obviously the competition in terms of technological development. So obviously China is really ramping up their tech development on the 5G side, on AI and other advanced technologies. So in the short term, what do you see this kind of like tech development we have been observing in the Chinese market would mean to the property sector? Like, are more tech firms moving into China?
Well, I think it's in a two-way thing. There will be more technology firms moving into China, but at the same time, there will be some more startups coming to Hong Kong as well. I think what we've been seeing in the market, of course, this kind of 5G or innovative technology has already becoming a new stream of demand drivers no matter in the office market or in the logistics market. And actually, even for the retail market, the new technology has also bring for a new dynamic landscape because retailers nowadays, other than the product that they produce themselves, they also very care about the retailtainment, how they interact with their customers. So these kind of interactive apps or facial recognition, these kind of big data all have different implications to the retail market as well.
Yeah, so in the short run, you just said US-China trade war will always be kind of in the background. But what are some of the most immediate risks that could still, say, cloud the outlook for the property sector in China specifically?
Yeah, of course, other than the trade war itself, I think one of the things that trade war bring for the, other than the uncertainty, is also because of the earlier imposed trade tariffs that is still in place. So it will very much depending on how the two leaders are negotiating in terms of these trade resolution in the later days. And I think we have also conducted an investor survey earlier on to ask about what will be the most challenges or risk factor the investor will be seeing when they tap into the China market. And I think one of the key factors or concern that they will have would be the policy risk, which is not a total surprise for us because especially for the overseas player, if they are not really familiar with the policies that how is it playing out in China, this will also be one of the top risks. And of course, how the Chinese economy, economic growth, and also the currency trend will be heading for the next couple of months will also be one of the investors' concern as well.
Yeah, as you just mentioned, investors are mostly concerned about one of the biggest factors would be the policies in China. So recently we've heard from the PBOC that they are rolling out like a confirmed timeline in terms of removing foreign ownership cap in the Chinese financial market. Do you see this having any sort of direct impact, positive or negative, to the property or office sector in China?
Well, I think, of course, with them withdrawing this restriction, this would definitely be a good sign for the market as a whole, especially with the renminbi internationalization and how the Chinese government is going to play it global to put the country at the current stage. So I think with the removal of this kind of restriction, of course, we are not saying that we will see the immediate impact of how they directly impacting on the property market. But I think with this restriction going off, maybe there will be more foreign capital tapping into the capital market in China as a whole. And eventually this filter down into different sectors, and it will means more business opportunities and also demand coming for the office sector.